Hello and welcome to another episode of the Investing with IBD podcast. It's Justin Nielsen here, your host, and we are coming to you live at 5 p.m. Eastern, as we typically do. Today is February 4th, 2026. So this, yeah, it's a great day, but not so much in the markets. It's been a lot of volatility lately, and to help us make sense of it, we've got Matt Caruso, founder and president from Caruso Insights, on the show. I often refer to him as the professor because you literally were a professor for a while, as well as a market maker. So you've got some experience, not only on the application side, but also on the theoretical side. So it's a pleasure to have you back on the show, Matt.
Thanks so much for having me back. And my wife can attest, I'm a little bit of a market addict, so I've kind of touched it from both sides of the equation.
Okay, perfect. Well, again, I think that just broadens your horizon and makes you a great guest. So let's get right into it. You know, just thinking about how the market's been really for the last quarter. We had these really kind of big moves. I feel like October 10th kind of was a shot across the bow. And I'm going to go ahead and pull up a chart real quick on the NASDAQ just to kind of remind people what I'm talking about. But back here on October 10th, really sharp drop on the NASDAQ. And then a even wider spread on November 20th. And it just feels like, even though we went into new high ground, it just feels like since then, it's been this sideways action. I personally, my top was back here in September, like September 22nd. That was
Mhm.
my equity curve high. And since then, it's been kind of a struggle. It's been tough. So I've gotten a bigger drawdown than I would have wanted, and I feel like I've been not being too aggressive, but at the same time, there's a lot of stocks that are moving so much,
Mhm.
yet the markets themselves have been really kind of lackluster. And you take a look at like RSP, which is the equal weighted S&P 500, and that was getting to new highs when the markets were kind of a little lackluster. IWM, the Russell 2000 small cap index, that was starting to take off. So let's just kind of start with your overview of the market, and just if you could tell me what the heck is going on.
Well, it's quite the intro lead there, but I agree with you. We know we trade a similar basket of stocks. I saw peak strength last year for me really ended. I think it was October 30th. November came in with a bit of a rough start to the month, and then after the end of year was choppy. I think
Hmm.
what really happened last year, because you have to think of the market, there's a bunch of different forces that are always kind of fighting each other. And one of those elements is positioning. So,
Hmm.
when people don't believe the move, if you go back to 2025, and you can kind of confirm this with a lot of like the surveys, whether it's the American Association of Individual Investors or there's the NAAIM surveys and all the rest, but most people were very much fighting the market trend throughout a lot of the middle of 2025. They didn't believe after the whole tariff bout that we were going to go into this bull market. AI was seen as like, that was like 2024 stuff.
Right.
And it was really as we got into that October period that a lot of the stocks started to move very strongly. That brought a lot of people into the market. And then sometimes, when the market gets to kind of more stretched valuations in the short term, a lot of these individual stocks, and then a lot of people get to the bullish side of things, you run out of this fuel for a consistent advance. And then a lot of late buyers are typically weak buyers. And so that means
Hmm.
that you have a lot of volatility. If you think back to the drops of April of 2025, the depths, whoever is buying it during that period, whether it's an institutional, it's retail people, as we rally off of that bottom, I mean, they're just sitting in profits. They don't ever, even on a market pullback day, they don't feel this drive like, oh, I got to get out of my stocks. They say like, oh, okay, the problem is resolved and now we should see higher. And so they're calm holders. When a large group of people come into the market after a big advance, they're very weak hands. And so you get through this very violent, choppy period, which is really typical after most uptrends. It's never fun.
Hmm.
It's never easy to see. But what's particularly tricky about this time around here is that I think AI is causing a real productivity boom. You can see it in the numbers, and that's so many people are fixated on the macro, and President Trump has strong views and all the rest. But AI is really driving a strong productivity. But there's this uncertainty. So rather than kind of seeing markets fall off aggressively, we're just seeing these violent rotations. Like there's not enough
Right.
a weak economy where institutions are doing, widespread selling, but as a stock gets wide attention and over-owned, it gets a quick drop, and then after it rotates elsewhere, and it's causing this very violent market tape. But there are elements to it that are kind of some elements that are kind of downright, I guess you can say negative. Like consumer
Mm.
staples are one of the best performers year to date. So, sometimes it's not so much what the indexes are doing. We were joking today. Hey, it was a quiet day today because the Dow finished positive. But if you look at the list of growth stocks, it's quite the different situation with things down 5, 10, 15%
Yeah.
plus. So this is a one of those unique markets that come around every so often where it really isn't a stock market. It's a market of stocks.
Mhm.
And that can be very tricky to trade. And you really need to be quick on your feet.
Hmm. Since you mentioned the staples, this is
Mhm.
something that again I'm just kind of baffled by because I can't think of times where the XLP, which is the sector spider for the consumer staples, and so you've got Colgate, Palmolive in there, and Procter and Gamble, and Pepsi, and Coca-Cola, Walmart. These are some of the things that are in there, and I just can't think of a time where I've seen XLP going at this angle,
Yeah.
whereas at the same time, at least for the beginning part of this, you had SMH also kind of trending along with it. Usually it's one or the other, right? You either have, these growth stocks moving, or you have the money flowing to XLP as institutional investors are trying to hide because they have to remain invested, but they don't want to be in the really, really volatile names, so they kind of go into the
Mhm.
the staples and hide their money or park their money there. So what do you think is happening here with the staples? And I guess the follow-up question here, before you even get a chance to answer, is um, you know a lot of times when things get back on track, the money comes right back out of the staples, right,
Mhm.
and back into the growth names. So I guess, is it worth putting the money there right now, or is this kind of a trap?
So, what I like to do whenever I have a hard period of time, I try and have a sanity check. Like, is it me
Hmm.
that's doing terrible? Am I way off? Is there something wrong? Like, I can't get a lot of traction. So, the relationship you just described, I'd gone back and I did a study where I like to look at like my periods where I did really well and periods where I was just like, head scratcher, like, man, Matt, have you ever traded before type of situation?
Right.
And yeah, and so a study I
Are you
kind of
sure you want to choose this as a career?
you're sure you're a professional investor, right?
Right.
But if you look at the relationship of like XLP versus the triple Qs, if you look at when that relationship is trending above its 50-day moving average, so when
Mhm.
the staples are not just going up, but they're just really outperforming the Qs. I went back and virtually that really describes all the periods of time where I have just a hard time investing because it's really specific to my style, which, we're on Investors Business Daily podcast. My style is this style. It's looking for these great transformative growth companies. And so it doesn't always lead to a bear market. Like, a lot of people will kind of say, oh, staples are leading, it's people getting out of the market. Sometimes it's just chop, sometimes it's short term, and then it resolves itself and goes the other way. And so one of the issues I had earlier in my career was that kind of lack of focus. So it's like, oh, well, the growth stocks are not working right now. Let me jump into the staples. I'll
Yeah.
make money where I can, and then I'll go back. But I found that there's a really big dividend that's paid for focus. So staying on track, because you're right. Then after, do we go into a deeper correction? Do we not? But then I'll tell you one thing is, I don't think PepsiCo will keep climbing at the rate it's been climbing for a long period of time, unless they've revolutionized colas. So
Uh-huh.
what ends up happening is that you kind of always in the wrong place at the wrong time. You kind of got hurt on growth stocks because you didn't have maybe good protection or sizing. Then you run to staples, those correct as growth goes back up. So you're taking a loss and then you missed your best entries. So I think sometimes it's good to kind of just realize, look at these relationships and be like, hey, this is just not a market very conducive to my strategy right now, which any business, I always say, if you're a toy company, you're not going to be expecting to make a lot of sales in January. Doesn't mean that you're a
Right.
bad company. It's just it's not the right season for your strategy. And I think that's just where we are right now. I honestly, my view is I kind of hope the Qs, the Nasdaq falls a little bit more because I think that kind of
Hmm.
wiping the slate clean is what's going to set the stage for a really strong rest of the year. Because apart from, I think, the short term dynamics of where people got probably too excited in the short term about AI, long term, it's an incredible opportunity. And there's, I forget the name now. Is it Amara's Law? I forget the exact name where, the statement is we tend to over exaggerate the impact of technology in the short term, but we underestimate its impact on the long term. And I think that cycle plays out in the stock market a lot because people get overly excited. Then the correction comes. They say, oh, it was a fad, it was a bubble. And then we kind of just get going back up to new highs. We saw that with NVIDIA for 2 or 3 years as every correction, that same kind of mental thinking goes through. So I think it's definitely not a great market. We can go to some other parallels in a little bit with some charts I sent in. But for me, kind of chasing into the staples is not part of my process. Through my experience, sitting on your hands sometimes is just the best thing to do.
Hmm. And just to kind of remind folks the point that you made about that ratio of
Hmm.
just looking at the XLP versus the Qs, for instance. One of the things that folks can do in market surge is you can go to your relative strength line, and you can choose here the Nasdaq if you want, or you can choose a symbol. So if you choose the Qs, here, we'll just choose Invesco QQQ Trust. What that's going to do is it's going to change. You can see I have two. One is to the SPY, and one is to the Qs now. But it'll change this to basically that ratio that you're talking about. So right now we're looking at XLP versus Qs, and you can see exactly what you're talking about. This is on a weekly
Hmm.
chart, but you can see how there are these very short periods of
Yeah.
outperformance, but they really don't last for very long. A couple months, we saw that. Oh, big surprise! The last time we saw that was during the tariff, tantrum in,
Hmm.
in March and April, and then once the market started coming back, okay, we're back to back to growth stocks. So yeah, I'm going to go ahead and put my thing back so that I don't confuse myself with all my extra lines. But yeah,
And,
that's
and
that,
I,
that's kind of an easy way to do it and get a relative look. And you can put moving average lines on there too, a 50-day, what have you, to your point.
And I'd recommend, put that 50-day moving average or 10-week average on the weekly chart and go back to your, like, for anyone watching, go back to your trading if you're trading this type of style and look at like the really choppy times where we didn't make traction. I'm going to bet you 9 out of 10 times it's because that ratio is over its average. So, again, rather than, and a lot of this business is psychological. A
Hmm.
lot of it is risk management, not getting a big drawdown, not getting down on yourself or very negative. Say like, okay, this is not a great season for me to be planting right now. It's not a great environment, but hey, let's go back. Let's be prepared for when that improves, and that's where all the outperformance comes. The whole outperformance is not looking away, from the game when it's not the best environment, but being there in time when the turn happens. I mean, take a look at last year. You could have done nothing till May or June, and still
Yeah.
had a great year if you were there at
Hmm.
the right time, kind of thing. So,
Hmm.
I think that's the best way to
Actually,
look at it.
your chances of doing doing well were better if you kind of
Yeah,
ignored it
exactly,
until May.
exactly.
Well, to that point, and for last year, okay, just using 2025,
Hmm.
I felt like it was easy to stay out of this whole mess.
Yeah.
It was a clear downtrend. There really wasn't that much of a temptation. Maybe right in here in March, where there was this, little move, but we got turned away at the 21-day moving average line. We were still below the 200-day moving average line. It just wasn't as tempting for me, as opposed to right now. There's all this time where we're like, oh, we're almost at new high ground, or the S&P 500 kept on actually breaking into new high ground. There's these stocks that are working, and going up not just a little bit, but I mean, we've had like the data storage stocks. We've had a
Hmm.
whole host of stocks making some really big moves during this time. So I felt like this was a little bit tougher to stay out of because it felt like things were happening, but yet I wasn't making progress. So I guess how do you manage that? It's not your typical where the XLP is outperforming because things are so bad. It's just like, oh, it's outperforming, but things aren't that bad. So asking for a friend, I guess.
Yeah, because the market is very strategy specific, and this is a good, and the market will correct in different ways. There's the broad market correction. This is like
Hmm.
a rotational correction, but this is the far more dangerous one. So there's really two types. There's, let's say, three types of investors. There's the buy and hold, where their biggest risk is a bear market because you're buy and hold, and bear market will just hurt you, especially if you're stuck in stocks that don't come back rather than the general market. Then there's like day traders. Like I was a market maker, day trader for many years, and the biggest risk for someone like that is more liquidity. Like if there's not a lot of trading, a lot of
Right.
action, you can get stuck in things, and like
Yeah.
that's the risk with that. for people who are looking for these great companies, we're trend followers. If I'm kind of putting my professorial hat on now, but we're trend followers. As a trend follower, your biggest risk is not a downtrend. Your biggest risk is a sideways trend because that's where you get
Yeah.
all of the false signals. So last year, the reason last year felt easy in comparison, because there was a little spat in January, but the rest was kind of pretty easy, was just because you had a bad downtrend, which for us, like I always say, it can happen to anyone, but I've been fortunate. I never got caught in a big bear market because, like, as a trend follower, your rules, if you're following them, should keep you out of that. So our biggest risk, our biggest fear and concern is a choppy market.
Hmm.
And so it's not the fun part of what we do, but that's really the kind of environment that brings out all of the other tools you need in your toolbox that most people don't think about. So that's the environment that really separates the really good traders, the professional traders, from those who are trying to figure it out,
Hmm.
because that's where your position size is important. That's where how many, your turnover, how many trades are you taking? How often are you failing? Like, are you on margin if you're not getting traction? All those things that most people don't learn about at first, because we always learn when do we buy a stock or what stock do we buy. But in this environment, you can cause so much damage over a quarter, over 2, 3, 4 months if you're overly aggressive with not the right strategy, that it's way worse or just as bad as a bear market.
Yeah.
So, in this environment, I think that's a great, if you see the XLP outperforming the triple Qs, as a simple tool, a simple strategy amendment is like, okay, well, I shouldn't be on margin, even if the markets are not below their averages. It's just maybe not a conducive market for trend following right now or for being on margin. And so you have to kind of build these tools into your process where you're able to kind of never make really big serious mistakes. We're all going to make small mistakes. I make them all the time. It's not been a very pretty year for me either. Not a bad year, but not a very wonderful year. But just avoid the bad mistakes, because then at some point you're going to hit a Sandisk, you're going to hit a Robinhood, you're going to hit a Palantir. But if you gave up all your capital and chop, well, then it still won't matter. So it's really managing this environment that's so critical for most people. And unfortunately, a lot of the literature, the stuff you're going to read, you're going to watch, doesn't discuss this part of it because it's not the fun part, but it's equally as
Yeah.
important.
Yeah, yeah.
Yeah,
The staying out and staying safe, protecting capital, all of that is again such an important
yeah,
part of the risk management side of things. But it's not the making money; it's the penny saved is a penny
yeah.
earned adage that a lot of people don't find as fun. But before we move on to kind of some precedent analysis, I also want to address something that you brought up earlier, because the sentiment side of things,
Hmm.
because it did it did feel like, yes, there were so many naysayers about whether the market could go up as all these tariffs were going on, and it kind of reminded me a little bit about COVID, right? It was like,
Hmm.
oh,
Hmm.
how can you even think of investing in April of 2020 when COVID is? I mean, we're still not sure what the heck is going on, and there were all these reasons that the headlines were saying, oh, don't invest, but the
Yeah.
markets were doing something else. So to your point, there was all this kind of negative sentiment in one way, but then there was also all of these talks of the AI bubble.
Hmm.
That a really weird dichotomy. Um, so I guess again, because AI has been something that we've been talking about for a while, it seems like there's a lot of people that are like, oh, well, the everybody knows about it. It's not new. It's kind of a known. And even the productivity part, we're starting to see some of these applications, but to a certain degree, there's still a lot of this unknown of who the winners are going to be,
Hmm.
who the you know how the productivity is going to change, because it's still so new, and so there's still a lot of speculation there. So how do you kind of mesh all of that together when you've got all of these things kind of coming at you, um, to make good decisions and kind of, I guess, cut through that noise?
So you bring up a lot of good points. One is, I would say, is don't become political with your trading.
Yeah.
There's the two sides of the coin. You could have thought in the fall of 2024, Donald Trump being elected was the best thing ever, and then markets tops and they corrected. Then in April 25, you could have thought Trump was the worst president ever, and markets bottom and they rallied. So, as much as possible, and I feel like people have become more political with time, but keep that totally out of your trading. Because even if someone is making a good or a bad decision, markets are looking at different time frames. They're reacting
Hmm.
to liquidity. There's so many variables. Keep politics out of it. That would be step one. And then step two, I think the relative, building a system that doesn't rely on you trying to understand through headlines. You want to have some really good guardrails. And that I have to give, props to, William O'Neill and everything IBD does, that you guys nailed that in my head so many years ago was relative strength.
Yeah.
And in this environment, that is the key to finding who's winning or losing. And rather than get worried about all the uncertainty, you know what? That actually creates the opportunity for us. There's a good book called The Rule by Larry Hite. He's one of the original market wizards, and he was a trend follower. And he
Hmm.
was, he brought up a good point that kind of stuck with me. He's like, news, whether it's good or bad, is what causes trends because the news puts people, out of positioning. Like something new happens and now people have to position and that creates the new uptrend as it gets into line. So all these new innovations, that's what's going to create all these great opportunities and the relative strength will point the way. At some point, the market will correct. There's so much demand for this stock that it doesn't break down. The second the market weight comes off, it breaks to new highs. But it takes focus to see that. If you're busy chasing PepsiCo during the drawdown instead of looking for that dynamic, and then you're busy dealing with a loss there if it pulls back as stocks are breaking out, well then you're never just focused in the right area. So ironically, like I have a copy of Bill O'Neill's book on my desk. I always go to it. It's like one of those books that the older you get, the more you read it, you always get new kernels of wisdom. Like it's
Right.
a real classic. And that relative strength is so key. So just take politics out, go down to like the key variables that will keep you in tune with the market and just avoid the big mistakes. Don't get bearish because you don't like the way things sound, or don't stay bullish just because you think it's a great company. Follow at least some certain key basic rules and always stay focused on relative strength. That's my process. And the past 5 years have been just the past 5 years. I've been trading much longer than that, but just the 5 years have been a real testament to just make sure you avoid the critical errors, and you're going to get a good opportunity that's going to come your way.
Yeah, no, absolutely. So, kind of related to the sentiment side, again, and this kind of talk of bubble, it's really hard for people to not make these analogs with the internet build out in the 1990s. And so the question becomes, where are we in that?
Mm-hmm.
There's some people that, oh well, we've been talking so long about AI, we got to be close to that 2000 side of things. Others are kind of, well, we're kind of in the middle. We've gotten some of the infrastructure going on. We don't know who the winners are. We don't have like the AOLs and the Yahoo,
Mm-hmm.
.com and these out there yet. So where you've done some analysis here, where do you
Mm-hmm.
fall?
So for me, the '90s are really the template I've been using for this environment. And if you look at the '90s, not just the price action, but you try and understand like how it happened, like the series of events. And it's very logical. It starts off with it was an infrastructure build out. Things like
Hmm.
Cisco. No consumer was buying Cisco routers and
Right.
switches. That was like that was the build out. That was the infrastructure. And
Yeah.
we could look at all the stuff that has been very strong recently, stocks like Celestica or Nvidia and power companies and all that. That's infrastructure. That's not the product yet. But if you look at the internet, the first from 1990, let's say when Cisco IPO'd, which we maybe call that the birth of the real internet rollout, until about 95, that entire period was really dominated by infrastructure type stocks, the computer makers. And if you look after that period, that's when all of the internet products came to market, Yahoo, AOL, Charles Schwab, and Amazon, all the rest, like the output of the internet. So if we look at where we are now, and we look at, the difference today is a lot of stocks are still private, and they're going to come to
Hmm.
market eventually, but they're still private. But you're seeing the changes of how we're going to new products based on AI coming to market, in that the software stocks have been terrible year to date. All of the
Yeah.
untouchable companies, Salesforce, Microsoft, they've had a terrible year because everyone's now concerned that, wow, AI is going to allow people to create so many new products at such a low cost. It's going to really challenge these massive incumbents. And so, if you take a look at 1995 as an example, just to kind of picture, so what do we expect here? And it's never exactly the same, sometimes surprisingly similar. But if you look at 95, we had that very strong uptrend, and that 50% gain came after a rough 1994. There was recession worries and all the rest in 94. And again, if you were worried about the economy, you missed a 50% gain where stocks did much more. And then after we went into this kind of very long multi-month sideways choppy period where on the chart it looks like, oh, it's a consolidation, but look, there was a false breakout that probably would have gotten
Hmm.
people excited, and then we went and broke the lower end and pretty much got people scared, and then ultimately we went back on our way. And after that, that's when Dell came to market and Yahoo and all these crazy types of moves. And if you take a look at the current market environment, even just price chart, never mind the rest of everything we spoke about, we have such a similar dynamic on the charts. We had this massive 50 plus run last year. We started this similar 10% correction. We just recently took out the highs. Now we're seeing weakness. So my base case here is very much that we're in a sideways consolidation that's going to do the job of shaking out all of the kind of the weak holders and those who are kind of naturally fearful, and that's going to set the stage for a tremendous uptrend to come in the coming months. I still think the rest of 2026 is going to be great, and this is really the foundation for setting that big trend up. And you can see that same dynamic, massive uptrend. We just took out the recent highs, and now we're kind of pushing to the downside a little bit. So it's
Yeah.
similar in context, it's similar in price action, and we're seeing a lot of similarities in stocks as well. So um, I'm still very excited about the future, but you have to be a realist in real time and be like, wow, a lot of these stocks are not having a good go lately, especially like today. So that's just managing the current, but not letting kind of current shop then dissuade you or turn you off from being ready when the market is good to go again.
And I would also say that, to your point, that correction that you pointed out in 1995 was fairly mild, right? And it was more stretched out, what I would consider a plateau, as opposed to when the Nasdaq topped in 2000. It had this kind of this mountain peak, right? A big move up and a very sharp move down. Just as a reminder for folks that maybe weren't around back then or weren't trading, uh, we topped on March 10th in the Nasdaq at like 5,132, and by the end of that month, you were already down 15% in just like
Yeah.
2 weeks. It wasn't like a back and forth. It was like, oh, you were already down 15% at the end of the month, and then it just got worse from there. To the point where you were down another, you were down 30% in just a month or two after that. And again, you had these rallies, certainly. I remember playing a very strong rally from, May, the end of May. There was a follow through day, and Sun Microsystems and Corning and, JDS Uniphase, SDLI, Keithley Instruments. There were all these stocks that were, doing really well, but it was short lived, and then another leg down. So it does look very different to me.
I don't, it's strange that so many people are using that as a comparison point because I don't think we see the broad kind of blow off tops and, even stocks that are going kind of vertical lately, like SanDisk or Micron, and they have massive earnings from a real bottleneck that is developed and they have, if you look at their earnings, I mean, they're unbelievable, even forward earnings, because basically these AI hyperscalers are willing to pay whatever for the storage because it's a bottleneck right now. The 90s was dominated by so many IPOs and junk companies that had nothing, and then totally different, So just the fact that we're kind of everyone is still pointing to that, there's this odd, I feel like societal thing that's built up, and like if you look at the data, you'll see it too. Where I've seen a lot of interesting articles where like on YouTube, a negative looking thumbnail with the same content will far surpass what is a positive messaging thumbnail.
Yeah.
And so, and maybe it's the human instinct, like we're designed to
Yeah.
kind of, be fearful and protective first, but it definitely doesn't point to kind of like this widespread euphoria. I mean, if you just think back to even just the COVID bull market, like how excited everybody was and all in on Bitcoin and Tesla. And I feel like, I don't know, maybe it's my circle, but and what I read, but I definitely don't see that on a wide basis at this point. But regardless, I think if you just look at it less from, what is everybody thinking, and you look at the process of like, infrastructure comes out, then you get new products, and that drives new productivity and innovation. AI is not like in the mid 2000s there was like 3D systems and
Yeah.
SSYS, and there was going to be this 3D printing was going to change everything, and there was no
Change
traction.
manufacturing, right?
But
Bring
yeah, exactly.
manufacturing back because it was going to be, do the prototypes and everything.
It was going to be this huge change, but then people realized, there's a lot of issues with it, and it never caught on to the extent that people thought, and it just like flared out, and it was localized. I mean, anyone who uses the AI and at the speed of what it's moving at and everything, I mean, it's hard to. This really is less just a product and really a platform for innovation. That's now we're going to head into robotics and allow real world robotics and people to interact with that. I mean, what is that going to unlock? So the amount of innovation to come, and we're seeing it at such a rapid pace, very hard for me to kind of tie it with the internet. And it's so important to have the right mindset because that one, locking in that negative view will lock you out from all opportunity. Like it's happened to me. I remember, I caught Tesla early on in 2013 when it had its first leg up. And then I
Hmm.
was trading on the desk, and I remember some of the guys joking, like, oh, Tesla's got the same market cap as GM. That makes no sense. They sell a fraction of the cars. For some reason, that like stuck in my head. Like it just sounded right.
Yeah,
And then I
you're
totally
right.
missed the
That
next
doesn't make
script.
sense.
It does make, I mean, but for whatever reason, let's not get into those, but
Yeah.
for whatever reason, like I just then totally, I didn't respect what the market was saying. The market is
Yeah.
always the final decision maker. And then it allowed me to miss a major move. That's one stock. Imagine turning sour on, like, even let's say during COVID, you said, oh, no way there could be a bull market despite them dropping trillions of dollars of cash. You would have missed out on like tremendous like opportunities in so many stocks. So don't get a narrative fixed in your head. Like be a trader, an investor needs to be flexible. An analyst can take a position, and it's their job to kind of,
Yeah.
stick to it and try and justify it. An
Defend
investor's
it.
job is to make money and just stay with what the market is saying and try and understand the market and try and impose your thoughts on it. That's the way
Hmm.
I like to look at it.
So, someone in the YouTube comments is making a point here, and again, I just to kind of reiterate what you were saying on SanDisk.
Hmm.
The numbers here are just so baffling. Like, I mean, again, us just look at the estimates here. So, okay, going from 306 earnings per share for 2025 to 35.96 to 76.04 in 2027 in terms of the
Oh,
estimates.
is
Now,
that
of
also?
course, those are estimates, so it doesn't mean it's going to happen. But the fact that that's what the estimates are, what the analyst consensus is. But let's look at something like a Oklo, where
Mhm.
again, this was something that had a phenomenal move, and I
Yeah.
guess maybe people are thinking, okay, well, is this a little bit more like the 2000 era where you had people slapping .com on their name? They were, what we call the AI adjacent, and
Hmm.
they just didn't have any revenue. They didn't have any earnings, so there was a lot of speculation. So, what's kind of the difference here?
Well, so this is where like process comes. So like, I didn't trade Oklo. I missed out on that upside because my process is if you don't even have a product in the market, I don't want to trade companies like that. It could be you're not profitable at the moment because there's
Hmm.
some business models, like let's say the Amazon model, where our job is to grow as fast as possible, take a dominant position, we'll monetize it later. I can understand that, but there's the traction I can see based on, wow, look at the percentage of the market and the revenues.
Yeah.
So a stock like Oklo, I'm going to pass on that for that reason. But passing on that for that reason, and then just saying that, oh, the whole idea of AI is a bubble, or is not going to work because whatever reason. I mean, if you look at the number of users and also the revenue ramp for AI, for ChatGPT, for Gemini, for Anthropic, and I mean, those are real numbers. I mean, like I have a subscription to Gemini, I have a subscription to ChatGPT, and I'm happy to pay them. And I've probably canceled other subscriptions as a result, hence why the software stocks are
Yeah.
down so
Hmm.
much. But I mean, they're generating real revenue. So,
Hmm.
that's where I think you pick your poison. And I know like Bill O'Neill was always very adamant on having earnings and he wouldn't trade non-earning stocks. For me, I'm willing to do that. So we all have to pick like our avenue, but that's the whole point. It shouldn't be your opinion. You should have your set process that avoids you from making really bad mistakes just because you have a gut feeling or a hunch or you think something makes sense. Because the market can often do stuff that doesn't make sense in the short term because we don't have the vision or the knowledge or the data of others on the inside that can see better into the future with more accuracy. So that's the way I look at it, and I'm happy to pass on Oklo. I had a great trades on, let's say, on Palantir or on Hood last year, AMD, and so you just go
Hmm.
for what fits your style.
Yeah, that makes sense. Now, you brought up Anthropic, and this brings up kind of another thing that's again makes me wonder where we're at in the cycle. The IPO market is very different. There's a lot more of these companies that are getting so much money from venture capital they don't really need to go into the public market. They can delay that for quite a while, and when they do, by the time they do, a lot of times it's to allow the early investors to kind of
Mhm.
diversify and get rid of their shares, unlike what was happening in the 90s. And of course there was a lot of speculation there. I mean, the IPO market was crazy. People were just, their business model was throw .com on their name, and
Right.
that was it. So uh, how do you kind of look at some of these players where we don't really have that insight into, because they're private companies, we don't have that insight into how they're doing, the earnings behind them, or uh, do you think that we're going to have kind of that boost in the IPO market in the future? Because again, we're still, if we are in early stages in '95, for instance, I
Mhm.
mean, Netscape, the big browser, right? That came out in 1995. So where do you think that private versus public dichotomy is going to play out?
And they used to call that the Netscape moment. And I think
Yeah.
that's why 95 is a good example because that's really where we went from infrastructure to product. But, markets change and there is that dynamic now that is different where the venture capital uh, market is just much bigger. They can fund things too much. I mean, look, SpaceX is going to come to market at $1.25 trillion valuation, which is never
Right.
would have happened before, right?
Yeah.
But
Yeah.
in my opinion, human nature is human nature. People are if people are going to need access to capital, and if you look at last year, CoreWeave came to market, NBIS came to market. Those had tremendous upside moves. But if you look also at 2020, 2021, the venture market was already established. It wasn't like the 90s. And human nature is human nature. These guys sense when they can make a lot of money bringing things to market. And look at all the SPACs that came out. That was a new
Yeah.
way. The market is always the same. It's always a little bit different, but rather than calling them IPO, they rushed all of these SPACs to market, and they had all these kind of crazy moves and all this stuff. And that was another hallmark, another sign that we were really kind of getting at the end of things there.
Hmm.
And so that's why I think with this whole environment, before we call it like a .com peak or some kind of bubble, you need those hallmark signs. You need that shows the euphoria, which we're not there. And again, if 2021 is a guide and the 90s are a guide, there's going to be a point where demand is going to be so strong because people have become euphoric that all of this stuff will come to market. That will be junkier, just like the SPAC stuff was junkier without revenues. There were blank check companies that were going to supposedly start a business and same. So again, human nature, same thing as .com. They called it SPAC instead of IPO. And
Yeah.
so I expect something like that will come out eventually. But another sign that we're not there. But definitely as we keep growing, I think people are, SpaceX is coming to market. There's talk of OpenAI coming to market, and there's only so much debt companies can sell, and we're seeing that with Oracle and the rest. So I imagine a lot of these smaller companies are going to come for public listings, and there's going to be plenty of opportunity. And if not, I think just the existing names that are out there, there's already plenty of opportunity. So
Hmm.
I think rather than get that negative train of thought, which is normal in choppy environments and whatnot, like I'm just super excited about the future.
Right. And I do want to kind of also shift to another question that came up on the YouTube
Hmm.
comments, was this whole idea behind the silver trade. Now,
Right.
you and Jason Shapiro, of course, has been on the show a number of times. We just had him on, not too long ago. It's so interesting. So you have a podcast called Markets Unscripted,
That's right.
and you both have very different styles of trading, right? I mean, Jason Shapiro, I mean, he's looking at futures, he's looking at the COT, and really trying to be on the other side of things, the contrarian look. Whereas you're of course bona fide trend follower.
Hmm.
So one of the things that again, this YouTube comment on the whole thing with silver, and this was something that came up in kind of our discussion with, oh, that's not the one I wanted to show. Oh, I'm gonna try that again. My market surge over here. I want to take a look at silver, because I mean, Jason
Hmm.
admittedly was like, hey, my metrics were not showing a problem here, and obviously there was. So
Yeah.
what's your take on this? And let's go ahead and just throw in Bitcoin for fun in there, because a lot of people are looking at this down 40%,
Yeah.
and you know. I mean, you can blame it on margin requirements for silver changing and everything like that, but does that change anything for you, or does it tell you, oh, this market's just crazy and doing crazy things, or what does all this mean in your kind of analysis?
So first of all, when we started the podcast, it's actually I had a in-person conference last fall. Mike Webster came. It was great to have him. We all got to hang out, and Jason and I, we got to talking, and our styles are as opposite as they can be. But
Right.
we were just kind of saying like how it's actually the perfect combination because in a big old uptrend, you want to be doing my style. And then at the extremes, the top and the bottom, you want to be doing his style. It kind of actually covers the whole cycle of things. So that's kind of, we got to talking about music and stuff. We got along. And so we thought it'd be a great opportunity to have both styles instead of just an echo chamber of
Yeah.
one style. But and we also had a strong mutual respect just for the process. And I think the silver is a perfect example. His job, his process is finding these tops and all the rest. Like he said, he said I totally missed it. But again, the job of an investor or a trader, you're looking for a good opportunity where your risk is small and your upside is big. Your job is not to figure out everything that's going to go on in the market. Like,
Hmm.
how many stocks have massive moves up and massive moves down? You can't know what every stock's going to do. So, I think a lot of us, we kind of get into the market and then we kind of get all this pressure on ourselves, being like, oh, I have to catch this move. I can't miss that. All you got to do is make money at the end of the year. That's your
Yeah.
primary job.
Hmm.
So, don't make any big mistakes losing money. Be right a couple of times really well, and you're going to be profitable. So, Jason caught the natural gas rip that
Yeah.
went up big time. He missed the silver drop. He didn't lose money on silver, but he made money on natural gas. It's still a win. But that mindset, that's why I like doing the podcast with him, because we have a similar mindset about trading, although we have different styles. I think that's how you have to go about the market. Now, how did silver impact my positioning in the markets now? Well, silver had been one of the leaders of this market. So, in the Bill O'Neill context of things, when the leaders break down, that's concerning. So I already had my concerns in the market, and one of the themes that I've been focusing on has been uranium and nuclear power because the president is pushing for that, and there's obviously the demand from AI and all of the rest. And so I had a position in Cameco, I had a position in NLR, which is the uranium ETF. And so when I saw silver breaking, I already had my concerns about the market, but my experience is when things break, people don't always, sometimes the saying is when you can't sell what you want to sell, you sell what you can sell. So what happens in very fast breakdowns in markets is all the assets start to trade together because someone gets stuck with a big loss. They say, I can't sell silver. It's down 40%. How can I sell it now? Well, at least I'm up still 12% on Cameco or, my uranium stocks. Let me sell those. And the guy who's holding silver probably has other commodities that he's holding as well. So a breakdown in one part of like the market can then break other parts of the market. So when I saw silver break, and also, I'd been concerned about the market, that was another reason that kind of pushed me more towards a full cash position. And so I took some profits on CCJ and NLR and I moved aside. So that's kind of how silver impacted me. But just in general, when looking at these things, we can't predict every move, and that's not our job to do either. So that's kind of like just the way I view the whole silver breakdown. And
Hmm.
I think it's a good representation of how leverage has built up so much in trading today compared to the past,
Yeah.
because there's all these like double, triple, quadruple, levered ETFs. And so maybe people don't use margin, but if you use a triple ETF, well, that can a 40% drop on a triple ETF is quite the experience that I don't want to experience.
Yeah.
So that's why I
Yeah.
think the markets are moving faster now than they did, 15, 20 years ago.
Yeah, and one of the things I was sharing with you, we used to kind of use as a measure of euphoria, margin debt.
Yeah.
And everyone would like say, oh, margin debt, it's the highest it's ever been. Well, that didn't really matter to us. We always looked at the year-over-year comparison. But now, I'm not even sure if margin debt is useful because you have
Yeah.
all of these ways to use leverage without using margin. So, to your point, I guess does that add a problem, I guess, for the market when you have some of these stocks that move very fast anyway, because again, whether it's on earnings or on news, so they're moving fast anyway. And not only do you have, I mean, it's one thing when you had the ETFs that were leveraged, but now you have leverage on
Yeah.
single stocks. And you know, just a couple years ago, it was, oh, okay, the Mag 7, okay, I get it. But I was stunned at how quickly, like, some of these IPOs were getting single stock leverage products out on them, like, so quickly after their IPO. So I guess does that level of speculation again kind of make it a little bit more problematic, or maybe a little bit more analog to the speculation that was going on in 2000?
I think that's more of a global thing because you're seeing it also like there's prediction markets and all the
Yeah.
rest, and then they
Hmm.
want to go, crypto, and they want to go to 24-hour trading. So I don't think it's like a specific like AI bubble. I think that's just the way society is pushing. I think it's like I don't personally don't like gambling. Like I work so hard to try and find an edge in the market, like going to a casino and gambling when I know the odds are against me just goes against my brain and everything I've worked towards. But the unfortunate thing about the market is that it's a great opportunity, it's a great investment. But if you want to treat it like a casino, you can treat it like a casino. And unfortunately, I think a lot of the exchanges and are going 24 hours to cater to that kind of
Yeah.
what is popular, and there's a tremendous amount of money that's being made there, and so it's going that direction. So, what does that mean for markets? I think you're going to see more exaggerated moves in both directions. I think it's going to make uptrends happen faster and be more incredible, which is going to create opportunities. But then after, if you're in the wrong place at the wrong time, it's going to make drops be more detrimental or dangerous. So it's more opportunity, but you need to be trained, and that's places like Investors Business Daily, and that's where you get that kind of understanding to protect yourself, which I think becomes all the more important. And again, like my saying is, once you protect your risk, at some point you're going to get it right. You have to just stay in the business long enough so that you can get it right. So step one is protect your risk. Use those tools, even if you're frustrated. I can be frustrated by not losing money just by chop. But then I go play with my kids, and okay, it's a new day. Losing 60% of your account is a different type of frustration that doesn't fix so quickly. So
Yeah.
just manage that risk, and then if people want to gamble and it creates more volatility and more dramatic moves, maybe it works in your favor, and just make sure it doesn't work against you. That's the way I look at it.
Yeah, no, very, very wise words there. The risk management. And again, this is just one of those things that you see. The more you study the greatest traders of all time, the more you see that risk management is so important to all of them. It's one of those just blanket features that they
Yeah.
all great traders seem to have. Is they have a really good, strong rule about how they manage their risk.
It's funny if you read any book like with great, whether it was William O'Neill, Paul Tudor Jones, Stanley Druckenmiller, like everyone wants these words of wisdom from them, and anyone who's ever traded for a long time, the first thing they'll talk about is like just try not to lose money.
Yeah.
Because it's right, whether they're trading bonds, futures, currencies, stocks, day trading, like it's the common thread that links everybody, because that's the difference that between someone who's approaching this like whether you're actually a professional or putting a process, a real process in motion, or someone who's just kind of hoping for the best. Like that's really what separates both categories, in my opinion.
Yeah, no, absolutely. So, last question, and it's a
Mhm.
doozy. You've mentioned a lot about how some of these opportunities and where the shortages are. Whether it's
Mhm.
the SanDisk and the data storage, where again the projections are just like there's such a shortage. People are just they're going to need more and more and more for this infrastructure build out. What areas are you looking at in particular? Because I know you touched on CCJ, which is kind of on the power side.
Mhm.
There's the data storage side with your SanDisk. What areas are you kind of trying to understand to really kind of get that shortage idea wrapping your head around it?
Well, for me right now, the data storage side of things is gone, a little too far for me. And like I can't touch that right now the way it is. Maybe it goes higher, but it's kind of, it's had a massive move. I think a lot of that has been priced in. But what I've been looking at, where I think we're starting to see a lot of demand, is in the optical side of things.
Hmm.
And in different areas. So there's Corning, which they make, funny, go back to the 1990s, they had made a lot of the Ethernet cables and the rest because they made glass. They make very specialized glass. And
Hmm.
just recently, Meta announced a $6 billion deal with them to have access to these new cables that they're building for data centers. Copper has its limitations, and so a lot of them, everyone's kind of switching to optics and these types of specific cables. Another stock along that theme is Viavi, so the symbol is VIAV. They make testing equipment, and funny enough, they're a spin-off of the old JDS Uniphase, so kind of
Hmm.
coming back into favor. But they make testing equipment, and that business is a little more like a lockstep move. So it takes time for people to kind of move over to the new standards, which is happening. They're going to these faster like optical standards, and so when that happens, I think that's going to be a big push for Viav, and you're starting to see that strength get priced into the stock. So that's another stock to watch very closely. And others, I think everything that's kind of going to be robotics related, because I think robotics is going to be an AI product, but it's going to be like a real world physical product. Whether it's, I don't know if it's going to be in your house, but for sure, like, kind of commercial
Yeah.
warehouses, fleets, even, robotic taxis are basically robots. So if you look at companies like Teradyne or even Texas Instruments, and you're starting to see suddenly they're starting to really outperform the market. Even a Texas Instrument that had been left for dead, as the triple Qs
Right.
have corrected, suddenly there's strength here because they make a lot of the sensors for sensing the world, temperature control and all the rest that is important when these robots and things are working in real time. So I think those are the groups that are emerging, that are really interesting and exciting. So the market is not great right now, so it's been difficult to get a real pulse on these, but it would be if we can get that that analog to 1995 where the Qs can kind of fall another 5-6% and these set up, I think they'd be like you know A plus setups in my opinion.
Yeah, no, and one of the things, just again to that point, I'm going to bring up Cisco because you mentioned that as one of the big, the big winners, and I'm going to go to the monthly chart here. It's interesting that we we just got to the all-time high that it made back in March of 2000 at 82, just got up there. Now, granted, Cisco now has a dividend. It didn't before, but you would have probably gotten to new highs with if you consider the dividends. But if we just, I'm going to go back a little bit to, let me go back to 2005 to show that. I mean, here's
Wow.
that 94, 95 period right
Mm-hmm.
here, a 75,000% move that this had from its, double bottom base, from its IPO to its top in March of 2000. And you did have, I mean, a very long base here, some pretty deep bases along the way. So it wasn't like, you think of this as being straight up, but I mean, this was a full year of like, over a year
Yeah.
of flat basing action, so just because something is basing doesn't mean it's done forever.
In the era of like shorts or reels on Instagram where you have like a 10-second attention span, like waiting a year for a stock to come out of a base is like 10 lifetimes.
Yeah,
But
right.
you want to make sure you don't have any kind of preconceived issues that will hold you back from what you want to achieve. If your aim is to find like a huge monster stock, a huge big runner, like Bill O'Neill would say, how do you go from 50 to 100? Well, first you go to 51,
Yeah.
52, 53. And so, for people who kind of get, if a stock doubles and they're like, oh, it's a bubble, just because they assume it's gone up too much. Well, how can you ever capture a 1,000, 2,000, 5,000% move? It's got to double, triple, quadruple before you get there. So, the best, how to make money in stocks, just like look at those stocks at the beginning of that book and look at what's possible before
Hmm.
before people call things bubbles, because in such a transformative time with this new technology, I mean, imagine I could drop. I always tell people, imagine I could drop you in 1995. A lot of stocks went up, but like, wouldn't you want to be focusing on like internet stocks, knowing the future? So like,
Yeah.
similar environment. That's the way I like it. Just have good guardrails, good risk management. That takes care of your capital, and then the rest is like keep an open mind and stay flexible and look at the leaders and look at what's possible.
Hmm. Great stuff, Matt.
Yeah,
Really appreciate you coming on the show. It's always a pleasure to talk to you. One of the nicest guys around, and again, just such a great educator.
thank you.
CarusoInsights.com. People can go there. You've got a lot of great material there. And then, of course, the new podcast with Jason Shapiro, Markets Unscripted. And then also, I should mention you're active on X, right? You have some really great stuff there. Where should people follow you? And again, to get your insights.
So I'm on YouTube. You can look. Yeah, I do the Markets Unscripted podcast. I also put my own videos. If you look at
And that's
Caruso
on
Insights,
YouTube, right?
it's on YouTube. Also
Yeah.
at CarusoInsights.com, we have an open AMA on February 9th, next Monday. We're doing 2025, a year in review, all of the trades, how we did, stats and all, and some Q&A, so people can come sign up to that. And also on X at Caruso Insights. So you can find me if you're looking for me.
Okay, perfect. Thank you so much, Matt, for being on the show. I
Thank
appreciate
you
it.
so much, Justin. Always a pleasure.
Okay. That's going to wrap it up for us this week. Please join us next week. We're going to have Nancy Tengler back on the show. She, of course, is the Chief Investment Officer of Laffer and Tengler Investments. So it's going to be great to have her on. Hope you join us. We're going to be live at 5 p.m. Eastern Time as typical. Thanks a lot for watching. We'll see you next time. Bye now.